Ever pondered over the secret sauce of successful investing during economic downturns? The answer might be closer than you think: consumer defensive stocks. These stocks represent ownership in companies operating within the consumer defensive sector, which includes industries that provide essential goods and services. Think food, beverages, household products, personal care items, and healthcare products. These are considered necessities, not discretionary purchases, and people continue to buy these even when the economy takes a dip. This is why these stocks are less affected by economic downturns. As demand for their products remains relatively stable, these companies continue to generate revenue, making them a potentially safer bet for investors. It's kind of like having an umbrella when it's raining financial uncertainty. So, in essence, consumer defensive stocks can be your safety net in times of economic turbulence. Interesting, isn't it? Now that we know what consumer defensive stocks are, you might be wondering, how do I invest in them? Well, there are several ways to go about it. First, you can buy shares of individual consumer defensive companies through brokerage accounts. This method allows you to have a direct stake in companies that produce the goods we all need, no matter the economic conditions. Second, you could consider exchange-traded funds or ETFs. These are funds that track the performance of the consumer defensive sector as a whole or specific segments within the sector. They offer exposure to multiple companies through a single investment. Lastly, mutual funds focused on consumer defensive stocks allow investors to pool their money together to invest in a diversified portfolio of consumer-related securities. And where can you find these stocks? They're listed on major stock exchanges like the New York Stock Exchange or the NASDAQ, in industries ranging from food and beverage to healthcare. So multiple avenues are available for you to explore and invest in consumer defensive stocks. But why should you consider investing in consumer defensive stocks? What's in it for you? Well, let's dive in. First off, there's stability. These companies provide goods and services that we all need, regardless of how the economy is doing. So, even when times are tough, these stocks tend to remain relatively stable. They're the steady eddies of the stock market. Next up, we have dividend income. Many consumer defensive companies are established, successful businesses that regularly share their profits with shareholders. That means you could get a nice little paycheck just for owning the stock. Lastly, there's portfolio diversification. By including consumer defensive stocks in your investment portfolio, you're spreading your risk. If one sector of the economy takes a hit, your consumer defensive stocks could help balance things out. Stability, regular income, and risk diversification, isn't that a hat trick of benefits? Now that's a winning strategy for any investor. As with all investments, timing is key. So when is the best time to invest in consumer defensive stocks? Well, the answer to that question is like a perfectly tailored suit. It depends entirely on you. Your investment goals, your risk tolerance, and the current market conditions all play a significant role. Consider this: consumer defensive stocks are known for their resilience during economic downturns. Why? Because regardless of the state of the economy, people will always need essential goods and services. So during periods of economic uncertainty or market volatility, these stocks can offer a safe harbor. On the other hand, if you're looking for a steady source of income, many consumer defensive companies offer regular dividends. This can be particularly attractive if you're nearing retirement or simply want to diversify your income streams. But remember, there's no one-size-fits-all answer to when you should invest. It's all about your individual goals and risk tolerance. Just like a coin has two sides, investing in consumer defensive stocks also comes with its pros and cons. Let's start with the bright side. First, stability. Since consumer defensive companies provide essential goods and services, demand for their products tends to remain steady, even in economic downturns. Second, dividend income. Many of these companies offer regular dividends, providing a steady stream of passive income. And third, portfolio diversification. Including consumer defensive stocks in your investment portfolio can help spread risk across different sectors. Now, let's flip the coin. The downside includes limited growth. As these companies operate in saturated markets, their growth potential may be slower compared to other sectors. Next, competition. Intense rivalry within the consumer sector can impact profitability. And finally, regulatory risks. Consumer products companies can face challenges due to regulatory changes. As with any investment, it's important to weigh the pros and cons before diving in. After all, knowledge is power. Leverage on bullbearvector.com to find the right stocks and options to invest, helping you to save time and reduce costly mistakes today.